So, recording financial information. Let's take a look at Chapter 7. Tracking transactions. Financial accounting is largely a matter of keeping a financial history. So we do that is we record in the general journal, which years ago would actually be like a notebook you could pick up, would be the general journal. Nowadays it's kept in, computer software. So financial event is commonly referred to as a financial transaction. And how we do that is we record a journal entry. So what a journal entry means is we take a look and anything that happened needs an entry. We have to do something accounting wise. So if we're paying a bill, we need to record the payment of that bill and such. So let's take a step back and let's remember our basic accounting equation that assets equals liabilities plus net assets. The equation summarizes financial information, the financial position of the organization. Basically, it's on the balance sheet. The most important item to remember is that it must always be in balance. So if one component changes, the other, at least one other changes. So if assets increase, then your liabilities and net assets, one of them would have to increase also. So it's a double entry system is a journal entry. And what that means is we have debits, we have credits, and at the end of the entry, the debits and credits have to balance each other. So say you debit something for $10, there needs to be a credit in totaling $10. So what a debit does is it increases in assets and expenses and decreases in liabilities and revenue. Whereas a credit is the complete opposite. It increases in liabilities and revenues and decreases in assets and expenses. So one of the items I like to use to learn this is really it's an acronym kind of. So it's AEDLRC, which really stands for After Eating Dinner, Let's Read Comics. And what that is, and I will show you on an Excel, actually spell this out for you, for those of you that are having trouble taking notes on this item. So what happens with a journal entry is you actually make what's called a T account, which means you draw a line across and then a line in the middle of that line. And the left side is a debit side and the right side is a credit side. This is, essentially before computers, this is how people used to write out in their general journal and actually make a journal entry. So what on the left side, on the debit side, would be assets, expenses, and what's called a draw, which we'll get into much later in the course. But what the reason they're on the left side is it means that a debit increases those items. And on the right side, on the credit side, there's liabilities, revenue, and capital, which is also known as equity. And the reason those are on the right side is if you credit that item, it increases those items. So, and don't forget, I will provide, this in Excel for you. So let's take a look at an actual example. Just for a note for you, I do find, maybe you understand slide 6, I do find slide 6 rather confusing. If you get it, that's wonderful. Otherwise, I will certainly provide the T account for you. So let's all take a look at Table 7.1, the balance sheet, which we discussed. Remember, we have assets on the upper side, which has current assets, and then it has the long-term assets. And long-term in this example is plant and equipment. And then we take a look at the liabilities, which has current liabilities and long-term liabilities. And then we have net assets. So if you look, the total assets of $300,000 equals total liabilities and total net assets of $300,000, which is in accordance with the accounting equation. So let's take a look at slide 8. Slide 8 shows us journal entries. You see the debit, DR is for debit, CR is for credit. And so basically, in example 1, they're paying their 3-year fire insurance policy in advance. And what advance means is, say it's, say it's for fiscal year 14, 15, and 16. We're not in those years yet, but I don't know, somehow they thought that it would be useful to pay the policy up front. So what happens is there's an asset called prepaid insurance, and they're debiting, so they're increasing the asset, the prepaid insurance asset, for $6,000 because that's what they paid out for that policy so far. So then we're decreasing cash for $6,000 because that's how much they paid. So basically, cash is going to the organization, the $6,000. So we're crediting that to decrease it, and then prepaid insurance is increasing because we've created an asset that is prepaid. So if we take a look at example 2, remember a supplier is someone that we bought merchandise from. So, in my hospital bed example, you bought $30,000 worth of hospital beds. So what happens here is you actually need to, you're paying the bill. So you've received the bill, you've received your beds, and now you need to pay your bill. So what you need to do is take it out of your accounts payable because that's where you recorded it. When you recorded, what you made a journal entry, when you received the supply information, the supplies. So for $30,000, you originally credited it into the account. So now what you're saying is, okay, I'm paying my bill. I've recorded my bill, but now I need to pay it. So you're debiting accounts payable to decrease the payables, and you're crediting cash for $30,000 to decrease your cash because, once again, essentially you're writing a check for cash. So if we take a look at slide 9, you sign a contract for $20,000 for a piece of equipment. So the real reason there's no journal entry for that is because nothing has happened yet. You've signed a contract. You haven't received, sorry about that, you haven't received your piece of equipment. Therefore, there's no financial event and no journal entry. So what about inventory? What if you purchase your inventory? So you purchase inventory on account, and what account means is you purchase it, you don't pay them cash, you owe them the money. So you basically say, okay, it's like an IOU, but you owe them the $30,000. So what you do is you actually debit inventory for $30,000 to know that you're receiving the inventory. And then you're crediting accounts payable to know that you have a liability that you owe that company the $30,000. So anytime you would receive inventory, you would write this. Say you had paid cash for the inventory instead of accounts payable, you would have the account cash. So let's take a look at the 5th example, cash payments for insurers received. So this basically is when you receive the money that you were due, right? So I received $28,000 for a service I had already provided. So what happens is you receive the cash, right? Everyone knows if you receive money, some money's coming in and you have to deposit that, right? So you will record the deposit of $28,000 by debiting cash. And then your accounts receivable, you will decrease your accounts receivable by crediting it to note that you actually received your $28,000. So when you provided the service, you would actually have debited your accounts receivable originally, and now this is the second half of actually receiving the cash. So the patient discharged who used $58,000 of inventory. I mean, they used a lot of inventory. I'm not sure what they were doing here. And whose insurance company was billed $112,000. So here's the entry. Here's what happened. You are due to receive the money, right? According to you, you are owed the money. So you will record a debit of $112,000. Into accounts receivable. And then your inventory expense is what you what you actually used of inventory. So this is an expense account. So you're saying, okay, I actually incurred expense of 58,000 for this. So you debit that. And then you credit your inventory by the same amount, the 58,000, because you used your inventory, right? So that gauze is gone. That that linen has been used. The needles or the medicine or whatever was in your inventory of 58,000 is now gone. So you need to decrease your asset of inventory on your balance sheet to note that you have used that 58,000. So then the last part of this entry is to actually record your revenue, right? You're owed the $112,000. You served this patient. They've now left. So what you do is actually credit your revenue. So the patient service revenue is increased by $112,000. So how we doing so far? Feel free to post some answers as you're going through this to our discussion, to our online discussion module. I will over next weekend, check it, and over the week. But feel free to bounce ideas off each other, or just come with, thoughts and things you would like to discuss further for these topics. I think once you get into doing the examples yourself and taking a look at the Excel, you might understand these items a little better. I mean, hopefully some of you have seen this, or from our discussions last week have taken a look at it. So here's the example. You order $18,000 of inventory. So you place the order. You call up your supplier and say, I need, $18,000 worth of this medicine. What do? You don't record a journal entry. Why? Because you haven't received the inventory. Until you receive the inventory, there's no reason to record it, right? There's nothing you can do. If you don't receive the inventory, you will never have to pay the cash. So that's example 7. That's why it says not a financial event. So what about employees, right? I mean, we obviously are paying our employees something. So here's the entry we make to record paying our employees. So we have actual expense of 16,000, and the reason we hit wages payable for 20,000 is because we'd previously recorded a liability of 20,000. So say you pay, biweekly, which is every 2 weeks. So week 1 you recorded a wage expense of 20,000, and then week 2 you're actually recording your labor expense of 16. So, but in week 2 you're also paying the expense. So that's the reason for the 16,000 not hitting the payables. You're actually paying the cash and you're paying the entire expense. So basically, when your checks get deposited or you cash your paper check, this is the entry they would make. They would hit your cash and credit your cash. So if we take a look, there's also example 9 of making a mortgage payment. So if any of us make our mortgage payment, we take a look and say, okay, really, I spent $20,000 paying my mortgage, right? 20,000 came out of my bank account, but what did it hit? Did it hit, were you paying your entire principal on it? No, unfortunately, we're not. You're right. We have interest. So the entry would include 2 items. It would include your interest expense and your mortgage payable. So in this scenario, 8,000 of your payment is principal, so you're paying down your debt by 8,000, and then 12,000 is interest expense. So that would be your entry. So if you take a look at example 10, what this is a year-end adjustment. So basically, during the year, you actually used some of your prepaid insurance, right? So we paid the entire policy up front, but now we're looking and we say, okay, we're a year later. We've used a third of our policy. So all you're doing is actually recording the expense by debiting the insurance expense and reducing your prepaid asset of $2,000. So really all you're saying is I consumed my insurance. I actually used my policy, or, the time lapsed on my policy that I've used a year out of my 3-year agreement. So, taking a look at this, I hope everyone can realize that there are certainly two sides and how the debit and credits always balance in this scenario. So, there are some other examples on 13, 14, and 15. I would like to note on example 12, depreciation expense. We will go over depreciation in other classes, just know that it exists. At this point, and what depreciation expense is we're saying the use of the asset. So in example 12, so I used essentially, whatever I figured, my car would last 5 years. So I used 12,000 of my car, depending on what I paid for it and such. But we will go over that further. So if we take a look at slide 14, here's an example of a T account. So what I recommend is actually using T accounts when you're doing your homework and actually write it down. You can use Excel if you choose. You just format the cells to draw the lines and such. But really what you want to do is you need to look at those two sides and say, what entry did I make? So if we take a look at this, the purchasing of the insurance, you can see how one side is on, so the cash is on the right side and the prepaid insurance is on the left side, which means those two balance out. So that's what I mean when I say T accounts. T accounts are very helpful when you're first learning this information, just because essentially you can take something. If you make another payment, you can record it in your cash. If you debit cash because you received cash, you can put 20,000 here and such. And at the end of the time, so at the end of the year or at the end of the month when you're reconciling this account, you should be able to come up with the sum total of the account. So what we have is a chart of accounts. So that's really where you keep your information, right? You don't just have T accounts. So my cash account could be account 1000. So they're normally assigned codes and numbers. So my cash account could be 1000. My accounts receivable could be 1100 and such, and like that. So what we do, when we make an entry in the computer system, we actually make an entry to account 1000, which is cash and such. So they can be used to differentiate assets and liabilities and net assets just by the numbers that you use. So say assets are in the 1000s, liabilities are in the 2000s, numerically. They can also be used to divisions, cost centers, so any way you want to differentiate. So if it's, accounting, the finance department has 01, so it would be 1001 would be their cash account and such. Certain things like that. So why don't we now take a look at Chapter 8, which is recording financial information, a closer look at the financial statements. So what might be helpful to look through this is you also had your notes from class on the 7th, which I showed out. I drew out kind of a balance sheet and such for you. So that's what we're talking about here. So financial information, reporting financial information is normally in certain time periods. So it's typically completed monthly, quarterly, and or annually. So financial statements themselves must be concise, which means when I pick it up, I need to be able to understand it. You can't just have assets on the right side, on the left side, down below liabilities. It needs to be in some type of order. So how we chose that order is really the financial statement itself. So getting from a financial transaction to the financial statement. So every account affected by the journal entry is an individually accounted for as a ledger. So think about it. Every account has its own page. That's how I like to think about it. So if I have the cash account, there's actually a cash ledger, which means, basically, if you want to take a look at it, the ledger could really be the entire T account. So for the month, you had, every day, think of cash really being affected every day. So you take a look and your cash is affected daily. So you would have, say 30 days in the month, you would have 30 transactions actually running through your cash. So recording those 30 transactions in total is your ledger. So each journal entry changes at least 2 ledgers, and by that, what happens is each journal entry has a debit and a credit, and it's not to the same account, right? So if I'm receiving cash from, so I received cash from what someone owed me, I'd be hitting my cash and I'd be hitting my accounts receivable. That's what that means. So if we take a look at the journal versus the ledger, the journal is a listing of one transaction, where the ledger is a running balance of the account. So begins with the ending balance from the previous period. So cash, starting January 1st, your cash account just doesn't disappear, right? So on December 31st, your year end, if you had $500 of cash, then when you take a look at January 1st, you start your new year, you will have $500 of cash in that balance. So what you do is then you record transactions from the current period. So the account would start out with 500, and then say on January 1st I spent $20. My account would now have $480 in it, and such. So here's an example of a sample ledger, and it can certainly look like this. If you want, and once again, it has the top accounting equation. It's a little different, but don't be surprised by this. I mean, when we do a ledger, you don't have to do it this way. It's just a way to track. It's a way to track it, and it's an example of how they use it. So the other part of the financial statements is the operating statement, which we've discussed in class, I believe, on the 7th. So if you take a look at it, you have revenue. So these are going by the examples we looked at. So we have revenue in chapter 7 of 112,000. So you take a look, and we've recorded our revenue. You have expenses. Remember, we spent inventory, we had labor, you have interest, and you have insurance and depreciation. So your total expenses actually ended up to be $104,000. So your increase in net assets, also known as your net income and your profit, is actually $8,000 through the example. So what the operating statement does is a comparison of your revenues and expenses. So it's taking from the ending balance of each account the revenue and expense. So basically what it means is, how well did you perform this year? Did you make money? Did you lose money? Making money means that the change in net assets is positive. Losing money means that it's negative. And a lot of people compare this to last year. And when you look at a year, you basically say, okay, well, last year I made $5,000. This year I made $20,000. What did I do differently? And the answer could be provided more services. Or the answer could be you watched the expenses you were using. Whether it was, okay, well, we don't need 80 pens and pencils and supplies, right? We don't need to be buying the top of the line toilet paper in the bathroom. We can buy medium grade and save ourselves a couple thousand. I mean, things like that companies are always looking at. You don't necessarily realize, oh, well, they cut back on toilet paper. I mean, maybe you notice. But the real item is, companies are always watching their revenue and expenses. So you need to look and realize how they're doing that and what they're doing with it, okay? So when they're increasing their revenue, did they bring in, are they now offering heart patients, whereas they didn't have a cardiologist before, but now that they've brought the new doctor in, the new cardiologist, now they're offering, cardiac services. Maybe they have a cardiac surgeon, things like that. So what are they doing to increase their revenue? But with increasing revenue normally comes an increase of expense. So even if you increase your revenue by $100,000, that doesn't mean that you've made an additional $100,000 in the end. So just know, whenever you record revenue, you're also going to incur expenses at some point, or you may have incurred them earlier. So let's take a look at the statement of changes in net assets. So what this really is it reconciles your net assets. It reconciles your equity. So remember, we talked about how you have a beginning balance and you have an increase. So the increase of the 8,000 in table 8.3 is actually the increase from the operating statement. So this ending balance at 12/31/13 actually will up. The $154,000 will show up on your balance sheet. Now, the other item this slide kind of introduces is permanently restricted net assets. You started with 20,000 and you ended with 20,000. So what that means is I, a donor, actually donated $20,000 to the hospital, but they can't touch it. They can't touch the principal, which means they can earn the interest. So most likely my 20,000 is invested. They can earn the interest, but they can't receive the principal. So my 20,000 will continue to grow, hopefully, depending on the market, will continue to grow and give them give them interest and dividends throughout the life of the organization. So really it'll mean that, they earn, say they earn $100 on this every year. So the organization will actually get $100 each year, depending. So permanently restricted means the principal of the money cannot be touched, but the earnings, depending on how the donor allowed it, earnings can go to the organization. So when you hear the word endowment, think of this. A lot of hospitals, a lot of colleges all earn endowments, and that's really how they make a lot of their money. It's basically people, donating money and allowing the stock market to work for the organization. So it's a continuing stream of income to the organization that you have donated. So let's take a look at example 10, table 8-10, slide 10. So it's really the assets and the liabilities. It's an example of the balance sheet. So if you notice on here from the table 8.3, you have unrestricted net assets of 154,000, and you have the permanently restricted net assets of 20,000. And once again, notice that total assets equals total liabilities and net assets. So that's just an example of how all of the previous information has been combined to create the balance sheet. The balance sheet, asset and liability balances come from the ledgers. The net asset balances come from the changes in net asset statements. And the assets and liabilities are segregated into short-term and long-term. Remember, short-term is anything within a year. Long-term is a year and a day and after. So the other interesting item these slides show is the statement of cash flows. So what the statement of cash flows really is what happened to my money? Where did it go? How did I use my money? So what I want you to take away from this is there's three ways we look at our money. We look at operating activities. So the general, what happened? I bought, I paid my employees. I paid my suppliers. I paid my loan. Things like that. As far as interest and such. So you need to look at those items for operating. So anything that was in normal operating mode. So the other item is, so there's three items. There's operating, there's investing, and there's financing activities. So on the statement of cash flow, those are broken out separately. So the statement of cash flows for investing activities is if you have investments, what was the change in those for the year? Or investing also includes property and equipment. So did you buy some new, did you buy a building? If you bought a building, that would go in there, right? In the change in investing, the cash flows from investing activities, that would enter into that. Whereas finance deals with a lot of debt or any owner financing. So if this is a private company and I contributed $100,000 to my business, this would show up here. So as you can note in this example of the cash flow, the payments on the mortgage principal only are in the financing activities, whereas the interest you paid is actually above in the payments for interest of 12,000. So in the financing activity, only really the change in your debt for this actual year. So if we take a look, the statement of cash flow, slide 13 notes the three sections. Just know for you that there are two different ways of approaching the presentation of the cash flow. There's a direct method, which is the example, and then there's the indirect method. I actually am used to the indirect method. but the book uses the direct method, so we will go off that. So on slide 14 actually shows you the indirect method, which basically starts out a little differently. It shows the net income as the top line. So to me, that's my profit. So I have a profit of 8,000, and then here's, operating wise, here's things I need to do. Here's other items I need to look at. And then from here, it shows net cash used for operating activities of 56,000. So operating wise, although I made a profit, cash wise, I used some of my cash. So at the end of the period, I actually decreased. I used $64,000 of my starting cash. So January 1, 13, I had $104,000 of cash. December 31st of 13, I had 40,000. So that's really what that summarizes. Where did my cash go? What did I use it for? So a lot of investors or people who debt companies are actually looking at this statement. So as I said, it starts with net income. There are non-cash changes with net income, and I will discuss these items with you further. Don't be caught up on the cash flow. Just know what it looks like. Know the sections, operating, investing, and financing, and we can certainly go over the cash flow later. Many, professionals are still even confused about the cash flow and taking a look. So I will provide you with a copy of an Excel that will also be posted for this class so you can look at. But please feel free to donate. Feel free to comment on the discussion board as far as your questions. Talk amongst each other. I believe in the accounting world and in class and in work in general, you bounce ideas off your coworkers. So use this discussion method as a way to explain it to yourselves and also pose questions to myself. So I will certainly post questions. I will probably look at it Sunday, more or less, and post questions, post answers or comments. But please feel free to look at this. These two chapters kind of summarize everything we've been looking at so far. So if you take a look at this, this will certainly help you. And certainly print out chapter 7 and chapter 8 as we're going through it and make notes as far as what I'm discussing. But as you notice in chapter 8, it does summarize and use information from chapter 7. So please, post on the discussion board if you have questions or items. And thank you.